This video will walk you through the first requirement of this bond problem. And so I've got a bunch of stuff written here. The first part of the problem says to record the entry of the proceeds received from the sale of the bond, but it's not that easy unless we're told explicitly in the problem how much the bond actually sells for in the open market. So we don't know any of that information, but we have all the components necessary to calculate the market price. We know the face value of the bonds is 32 million. We know the term of the bond is 12 years, and it has a coupon rate or a stated rate of 12%, pays interest semi-annually, and the effective interest rate is 14%. These are all very, very important pieces of the puzzle as we go and work through the problem. So remember a couple of things, and I have some pictures down here. Is this bond is nothing more than a contract entered into between two parties, and the bond issuer is the borrower, and the lender or the creditor are the bond holders. So this usually isn't an institution like a bank or something, but it could be. It could be made up of many, many different bond holders, and so there could be a lot of people on this side of the transaction, but the essence of the transaction is the same. They're going to give us some money. In exchange, we give them a contract, and the contract is stated up here, all of the details. So, and when you think about that contract, we can state that contract in terms of cash flows, a series of cash flows that happen, and I've done that down here for us. I don't have the right number of payment periods here, but at the end of the bond, right, the maturity date of the bond, which is 10 years from now, because it's a 10-year bond, the borrower, the bond issuer, has to repay $32 million. Way out here, they got to repay $32 million. And if we're on this side of the transaction, and as the lender, we're trying to determine how much money am I going to put in this duffel bag and give you today, if you will give me all of these series of cash flows in the future in this one big cash flow. Okay, so all along the way, we are going to, if we're the borrower, make periodic payment interest, or periodic payments in the form of interest. And the amount of those interest payments is stated when we look at the stated rate or the coupon rate, and we multiply that by the face value of the bond. So the first thing we have to do is determine the size of the interest payment. And so the interest payment is simply going to be the face value of the bonds, this 32 million, times 12%, 0.12, and that gives you $3.84 million. But remember, that's stated in annual terms, and the bond pays interest semi-annually. So this is too much when we're looking at how big is the interest payment every 6 months. We have to actually create a formula that says we'll take that 32 million times 0.06, 1.92 million. We make a payment of 1.92 million every 6 months until the bond matures. So now there are two series of cash flows, the interest payments and the repayment of the face value of the bond, that the lender is going to determine when they figure out how much to give to the borrower. Okay, so we first have to calculate the present value of all these little interest payments, and that's the present value of an annuity. So this is the formula. The present value of all those annuities is the formula of the size of the annuity times some factor off of the right table, based on the tables I've given you. So we know the size of the annuity. We just figured that out. The interest rate that we use, now here, don't get confused. Remember, we always use the effective interest rate to discount the cash flow. The stated rate is only used to determine the size of the interest payment. So instead of 14%, because the bond pays interest semi-annually, the interest rate is 0.07, 7%. The number of periods is not 10 because we make semi-annual payments. So the number of periods is 20. So we go to our little table and we find the factor. This is the present value of an ordinary annuity, and the factor, if you go over to 7% and down to 20, is 10.594. So the present value of all those interest payments is the annuity times the factor. The annuity times the factor, $20,340,480. Okay, so that's what the lender is willing to give us for all these payments. but they're also willing to give us some money now for this return of this $32 million. So we find the present value of that one single payment at the end of the uh, uh, bond contract. So the face amount of the bonds is 32 million. The formula we're going to use is the present value of that equals the future value, which is 32 million. Future value times the factor. The interest rate is still the 7% and the number of periods is still 20. So now you have to go to the table, present value of a single payment, present value of 1, and you go over 7%, you go down 20, and you come up with, you find the factor of 0.258. So the present value of the face amount is the factor times the future value, 8.256 million. You add both of those together, and what that tells us is the lender is willing to give us today's value of all these cash flows combined. They're not going to give you a penny more than $28,596,480, which is significantly lower than the $32 million face value. And again, the reason for that is the lender is saying, no, this bond, the risk that's inherent in this bond should demand a 14% return. You're only going to give me 12% in your interest payments. I'm not going to give you $32 million to earn 12% because it's too risky of an investment. So you must up the ante, increase the interest rate to 14%, and the way we increase the interest rate is by reducing the amount of cash we're paying. So by giving them $596,480, we're earning 14% on all those cash flows. Okay, so that's how we determine the market price of the bond. And so now we have to journalize that, right? This is an accounting class. So we know that we're going to, let me just unhide this here. What's going to happen is on the issuance date of the bond, it gets issued on July 1st of 2016. We are the borrower. We get cash, and the amount of cash we get is this size that we just figured out, right? And so in exchange, I'm going to skip a line here. We record a bond payable, which is a long-term liability, for the face amount of the bond, $32 million. Debits don't equal credits, and they have to. The difference here is $3.4 million, and that goes to this account called Discount on Bonds Payable. So that's the journal entry to record the issuance of the bond. And a couple things, right, is we wouldn't put into the balance sheet some future value or future dates of liability, which is what this is, $32 million. And actually, the size of that obligation in today's dollars is 28 million. So you would net the long-term liability of 32 million with this contra liability account of 3.4 million. And so what I would do then, and I've got a balance sheet down here. I think it's important to maintain perspective into what happens after this transaction on the balance sheet. And we're the borrower, so our cash is going to increase by that 28,590. So that's what would happen, right? And we know the balance sheet at this point would be out of balance. We would also have to subsequently record a bond payable amount of the 32 million right here, because that's what we did in the journal entry. So I'd have $32 million in the balance sheet, but the balance sheet doesn't balance, right? So what happens is we net that face value of the bond with this discount and multiply it by 0.1, right? So I then have a total liability increase of 28,596,480. So the balance sheet balances, my long-term liabilities, which is where I have this classified, have increased, and my current assets have increased. So that's the kind of a long explanation, but that's the really the details of how the mechanics work when you issue a bond with a stated rate that varies from the effective or the market rate.